Nvidia has announced a groundbreaking investment plan, committing up to $100 billion to OpenAI, starting in 2026, marking what could be the largest private company funding on record. This strategic partnership will see the deployment of at least 10 gigawatts of Nvidia systems to bolster OpenAI's AI infrastructure, crucial for developing advanced AI models. The initial phase involves deploying 1 gigawatt of systems in the latter half of next year, initiating a $10 billion investment. This collaboration aims to secure Nvidia's dominance in AI computing and ensure a steady supply of advanced hardware for OpenAI, mitigating risks of supply shortages and rising costs. Additionally, it complements OpenAI's recent $300 billion deal with Oracle, enhancing its operational stability. However, the investment has sparked concerns regarding its sustainability. Some analysts, like Jay Goldberg, caution that the investment structure, akin to vendor financing, may artificially inflate demand for Nvidia's products, posing risks during market downturns. Goldberg also notes Nvidia's substantial valuation at nearly $4.4 trillion could limit further upside. Despite these concerns, the deal positions OpenAI as a significant player against tech giants like Google, Amazon, and Microsoft, who dominate the data center semiconductor market. While the potential of AI is promising, uncertainties surrounding AI adoption and capacity constraints could impact Nvidia's performance relative to the sector.
The Organization for Economic Cooperation and Development, OECD, has issued a warning about the delayed but significant impact of President Donald Trump's tariffs on the U.S. economy. According to the OECD's latest report, global growth is projected to decline to 2.9%, with U.S. growth expected to slow to 1.5% by 2026, a marked decrease from the 2024 figures of 3.3% and 2.8%, respectively. The OECD identifies tariffs, immigration changes, and inflation as the primary threats to economic growth. Despite some companies initially absorbing the increased costs, the effects of America's effective tariff rate of 19.5%, the highest since 1933, are beginning to manifest in spending patterns, labor markets, and consumer prices. The OECD report suggests that the full economic impact of these tariffs is yet to be realized, as many of the changes are being gradually implemented. The Federal Reserve's recent decision to lower interest rates and Chairman Jerome Powell's remarks on the challenges young people face in securing employment underscore the early signs of economic strain. Furthermore, former economic advisor Gary Cohn has highlighted that companies grappling with tariff uncertainty are resorting to layoffs to maintain their margins. The OECD anticipates a noticeable softening in growth during the latter half of this year, as increased tariff rates on U.S. and Chinese imports begin to suppress investment and trade growth. Despite a slight upward revision in the OECD's growth predictions for 2025, driven by front-loaded trade activities and investments in artificial intelligence, the organization maintains a cautious outlook for the coming year.
The recent report by TT Club and engineering consultancy Haskinen has highlighted the vulnerability of global maritime infrastructure to climate change, with nearly 90% of the world's 3,700 major ports exposed to climate hazards. The report, titled Climate Ready Supply Chain: Urgent Guidance for Ports, Waterways and Logistics Operations, underscores the pressing need for ports to adopt resilient strategies against threats such as sea level rise and extreme weather events. Notable historical examples include the significant economic impacts from the shutdown of Gulf Coast ports during Hurricane Katrina and the $12 billion in damages from Japan's 2011 tsunami. The report emphasizes that proactive adaptation could safeguard long-term operational security and profitability, while inaction may result in escalating repair costs and disruptions. Key figures in the report, such as Marika Kalfas of NSW Ports and Neil Daluz of TT Club, stress the importance of integrating resilience into core business strategies. The report suggests leveraging technologies like IoT-enabled monitoring and AI-powered predictive analytics to enhance asset performance and emergency preparedness. Successful initiatives cited include the Port of Long Beach's Coastal Resiliency Plan and the Port of Brisbane's weather monitoring upgrades. Amy Savage of Haskinen advocates viewing climate adaptation as a strategic investment rather than a financial burden, highlighting the potential for such measures to unlock value across the supply chain. This report serves as a practical roadmap for ports aiming to mitigate risks and capitalize on emerging opportunities in the face of inevitable climate events.
Jio-Blackrock AMC, a joint venture between Jio Financial Services and the American investment giant BlackRock, has launched its inaugural new fund offer, NFO, in the Indian mutual fund market. This strategic move marks a significant entry into a market traditionally dominated by distributors. Despite the rising trend of direct investments through brokerage applications, the company plans to leverage advanced technology, including AI and alternative data sources, to generate investable insights and manage downside volatility effectively. The fund, introduced as an active flexicap fund, diverges from the anticipated focus on passive funds, suggesting a strategic approach to navigating market volatility using BlackRock's tested systematic investment methods. The entry of Jio-Blackrock is poised to potentially disrupt the Indian mutual fund landscape by accentuating the trend towards passive funds, as noted by Kotak Institutional Equities. While India has predominantly been an active investment market, the increasing share of passive funds could see a shift with Jio-Blackrock's focus, potentially prompting other asset management companies to expand their passive fund offerings. This development could lead to a broader transformation of the mutual fund industry, pushing it towards a more technology-driven, data-centric approach, with long-term implications for market dynamics and investor strategies.
Amazon is set to close all 19 of its Amazon Fresh stores in the UK, marking a significant shift in its retail strategy just 4 years after entering the British grocery landscape. This decision comes as the tech giant struggles to gain traction in the competitive UK supermarket sector, dominated by established players like Tesco and Sainsbury's. The Fresh stores, which were introduced with a checkout-free shopping experience, have seen dwindling demand as the novelty of contactless shopping waned post-pandemic. Amazon plans to convert up to 5 of these locations into Whole Foods Market outlets, leveraging the organic food chain it acquired in 2017, while shuttering the remaining 14. This move is part of Amazon's broader reorganization of its grocery operations in the UK, focusing more on its online services and the Whole Foods brand. The company is enhancing its grocery delivery options through partnerships with retailers such as Morrisons, Iceland, and Co-op, aiming to double the number of Prime members with access to these services. Despite the closures, Amazon's financial performance in the UK remains robust, with pre-tax profits rising to £500 million in 2024 and turnover increasing to £14.7 billion. The pivot underscores Amazon's commitment to a digital-first approach, aligning with its strategy to expand its online grocery offerings and streamline its physical retail presence.
The Federal Reserve's recent decision to cut its benchmark interest rate by 25 basis points has significantly impacted the mortgage market, resulting in a decrease in the average 30-year fixed mortgage rate to 6.13%. This marks the most affordable level for mortgage costs in the past 3 years and a notable decline from earlier in 2025, when rates averaged above 7%. The rate cut has spurred a surge in both new mortgage applications and refinancing activity, as borrowers seek to take advantage of the lower rates to reduce their monthly payments and overall borrowing costs. For those considering a $350,000 mortgage, the current rate environment translates to a monthly principal and interest payment of approximately $2,127.77, compared to $2,337.97 when rates were above 7%. This reduction equates to a monthly saving of about $210 or over $2,500 annually, which can provide significant financial relief for homebuyers and existing homeowners. Over the full 30-year term, opting for the current rate instead of earlier higher rates could result in savings of more than $75,000 in total interest payments. This environment may encourage first-time buyers to enter the market and existing homeowners to refinance, potentially unlocking additional funds for other financial goals. The implications of the rate cut extend beyond immediate savings, offering long-term financial benefits for borrowers. However, potential buyers and those considering refinancing should remain vigilant, comparing offers from multiple lenders and staying informed about future rate movements. While the current rate reduction presents a favorable opportunity, borrowers are advised to make informed decisions based on their financial goals and circumstances.
Federal Reserve Bank of Atlanta President Raphael Bostic highlighted ongoing inflation risks in the U.S. economy, despite the muted impact of President Donald Trump's import tariffs on consumer prices. During a Macro Musings podcast taping, Bostic noted that while businesses are experiencing cost pressures, these have not translated into the significant price increases many anticipated. He emphasized the importance of monitoring consumer and business expectations regarding inflation, suggesting that the psychological aspect of inflation could play a crucial role in future economic dynamics. Bostic refrained from commenting directly on the Federal Reserve's monetary policy direction, following a recent decision to cut the overnight interest rate target range to 4 to 4.25%. This rate cut was driven by concerns over potentially stalling labor markets, which could benefit from reduced short-term borrowing costs. Bostic observed that businesses are cautious amid current uncertainties, with neither significant hiring nor firing trends evident. The Fed's focus remains on understanding the complex interplay between inflation, consumer sentiment, and labor market conditions as it navigates its policy decisions.
Plug Power Inc., NASDAQ. Plug, a leader in hydrogen fuel cell and electrolyzer systems, experienced a significant stock surge, climbing nearly 15% in early trading before closing with an 11.9% gain. This boost was largely attributed to the company's better-than-expected Q2 results, which highlighted a 21% year-over-year revenue increase to approximately $174 million. The standout performance in its electrolyzer segment, with sales tripling to about $45 million, signaled a positive shift in the company's commercial momentum, a welcome change for a firm often scrutinized for its financial losses and high cash burn. The rally was further fueled by Plug Power's strategic positioning in the burgeoning clean hydrogen sector, which is gaining traction as a key component in global decarbonization efforts. The positive earnings report forced some short sellers to cover their positions, amplifying the stock's gains. Despite the surge, Plug Power's future remains uncertain, as it continues to depend on government incentives and faces challenges such as scaling production and maintaining operational discipline. The company's ability to sustain its growth trajectory could solidify its standing in the hydrogen economy, but potential risks, including supply chain disruptions and policy shifts, may impact its progress.
The cryptocurrency market witnessed a notable surge in the price of Sign, a blockchain project, following an endorsement from Changpeng Zhao, CZ, the founder of Binance. The price rally was triggered by CZ's comments on the ambitious SIGN, Sovereign Infrastructure for Global Nations initiative, a blockchain framework designed for sovereign nations. While CZ clarified that his involvement was non-technical, his endorsement significantly boosted Sign's credibility and visibility. This reaction underscores the substantial influence that key opinion leaders like CZ hold in the volatile crypto market, where their words can rapidly alter market sentiment and drive investor interest. The Sign project, backed by EZ Labs, formerly known as Binance Labs, aims to provide a comprehensive blockchain stack for national digital infrastructures, facilitating applications like digital identity, land registries, and cross-border payments. The institutional backing from EZ Labs adds a layer of credibility and suggests a strong belief in the project's potential. However, the long-term success of Sign will depend on its ability to deliver on its promises, secure governmental partnerships, and achieve widespread adoption. As the initiative progresses, stakeholders will be keenly observing Sign's technological advancements and its integration into sovereign digital ecosystems, marking a pivotal moment in the evolution of blockchain technology.
Farmers Trust Company has recently acquired a significant position in the iShares Bitcoin Trust ETF, NASDAQ IBIT, purchasing 6,180 shares valued at approximately $378,000 during the second quarter. This move is part of a broader trend among institutional investors, such as Brighton Jones LLC, Northern Trust Corp., and Bison Wealth LLC, who have also increased their stakes in the ETF over recent quarters. The iShares Bitcoin Trust ETF, managed by BlackRock, is designed to track the spot price of Bitcoin, providing investors with exposure to the cryptocurrency cryptocurrency market through a traditional exchange-traded fund (ETF) structure. The acquisition by Farmers Trust Company and other institutional investors highlights growing institutional interest in Bitcoin and cryptocurrency-related investment vehicles. This trend is significant as it indicates increasing confidence in Bitcoin as a viable asset class, potentially influencing market sentiment and driving further adoption among traditional financial institutions. The ETF itself has seen a notable performance, with its stock price ranging from a 52-week low of $33.47 to a high of $69.89, reflecting the volatile nature of Bitcoin prices. As institutional participation grows, it could lead to increased stability and liquidity in the cryptocurrency markets, impacting both the short-term and long-term outlook for Bitcoin and related financial products.